Hello, everyone. My name is Adeo Resi. I am CEO of the Decel Group, which is parent company of VC Lab. And I'm here today to talk to you about LP archetypes. What are they? How to identify them, and how to go through a process to close LPs from these archetypes. So we're going to be covering a lot of material today, and hopefully you're going to learn a lot of stuff. In fact, this might be one of the most packed webinars with content that we've done in a long time. Very quickly about Decel Group. Decel Group is helping emerging managers around the world launch transformative funds by providing training, tools, and capital. We run the leading accelerator called VC Lab that helps new and emerging managers spin up their funds and their firms to get started in venture. And we had 3,600 general partners apply to the last cohort of VC Lab. Beyond the training, we give tools. So we have something called Decel Hub, which is the leading platform to run your venture capital firm on. Currently, we have just under 900 firms using the platform for managing their limited partners, managing their deals, managing their back office, and more. And last but not least, we provide capital. So we have a fund of funds that invests in new and emerging managers, and we also match new and emerging managers with limited partners all around the world. So without further ado, let's get started on LP archetypes. So I'm going to share my screen and hopefully that goes really well. Here we go. You get to see my presentation, which is going to have a lot of exciting materials in it. Okay, so how do you find them? What are they, etc.? LP archetypes are going to be your major tool to succeed in fundraising, because if you don't target the right type of LP for your fund, it will fail. So what are LP archetypes? Well, they're groups of ideal investors for your fund. So there are literally almost an infinite number of LP archetypes that you can define, but most of them don't matter. There's going to be a few LP archetypes that are really good for you and your fund. And your job, if you're raising a fund, is to figure out which of those LP archetypes are best for you and to come up with a system to harvest and identify limited partners from those archetypes. And we're going to cover all that in this presentation. And so how do you figure out what an ideal archetype is? Well, it's pretty straightforward. There are three things that have to intersect. And at the intersection of those three things, there's your ideal archetype. So what is the interest of the LP? What is your background as the manager? And then last but not least, what is your fund thesis? And your ideal archetype sits at the intersection of those three areas. So the LP is interested in things from your background, and your thesis is related to your background and the interest of the LPs. And when that all happens, you have the perfect LP and the perfect LP archetype, and they will invest. Okay. And these individuals are not people you don't know, especially for new and emerging managers. They're either going to be first degree connections, which is people that you have a direct relationship with, or they're going to be second and third degree connections where you may know someone who knows someone, or you've met someone through a group of people and become friends with them. But it's very unlikely, at least in the beginning, that you're going to randomly meet an LP and they're going to join your firm and fund. If you get your LP archetype tuning really good, as you start pitching more and more and you get more advanced, and maybe you're on fund 2 and fund 3, then yes, you'll be able to meet people that you don't know, and they will invest in your firm and your fund. But in the beginning, it's primarily going to be people that you know and people that they know. All right. And so let's take a sample thesis here of someone running a e-commerce capital fund. And of course, like this is not a very realistic example because I don't know how many e-commerce capital funds there are. I mean, they're not zero, but they're not a ton. But anyway, so it's a sample e-commerce fund. And so what would be an ideal archetype for an e-commerce fund? Well, you'd want probably an exited e-commerce founder. So exited founders are excellent archetypes. And this is what a sample archetype looks like. So you talk about their role. The person was an exited founder and made his fortune selling his e-commerce business. You look at their background. That person's been an engineer. And this is a hypothetical, right? So your archetypes aren't necessarily actual people. What you want to do is create like a hypothetical person and ensure that there's enough of them in the world. So it's not like a hypothetical of one, but it's a hypothetical person that sort of captures the background of lots of different people. So I know a lot of people that exited e-commerce businesses, dozens personally, right? So the idea that there are dozens of e-commerce people out there that have exited is very likely. And then you want to sort of come up with a hypothetical background. A lot of them were engineers, right? So a software engineer by trade, he ventured into entrepreneurship in his mid 30s. So you sort of tell the story of this hypothetical archetype LP. You talk about what their interests are. He's been a limited partner before. He's interested in backing more startups that are doing more cutting edge work, right? And then you want to also think about some hypothetical thing about their personal background. So where do they live? How many kids do they have? What schools do they go to? And the reason you want to specify all this stuff about the archetype that is that you want to then start to be able to search for people and intersect with those people in the real world. So if you're looking for an exited e-commerce founder that's been an engineer, and they're maybe part of an alumni association with their university, you say, oh, well, maybe I'll start with an alumni association and see how many exited e-commerce people are there. So I wanted to show a sample early on, but really what I want to start to do is go through specific archetypes, take you through some processes, et cetera, to identify them for your own good. So obviously the most successful archetype for new manager is going to be your friends, right? People that know you. Now, obviously they're in your first degree network. They're very good to come into fund one. They generally don't come into fund two and fund three. They'll come into your first close, which is super valuable. And if you're lucky and you have rich friends, they might invest as much as $1 million, but most are going to be on the lower end of the 100K level. And they should be easy for you to close. So the difficulty in closing them should be relatively low. So it's relatively easy. And so everybody here, if you're starting a fund, friends are going to be where you're going to start your fundraising journey. And that's going to be the LP archetype that you're going to begin with. Okay. Then, next, and there's no particular order of these, but they are kind of ordered by difficulty. So the easier ones will come first, and some of the harder ones will come later. So if you're part of an alumni group or you're part of an affinity group like Women in Tech or whatever, you already have a shared background with these individuals. Many of them are going to be your first degree connections again. So they're likely to come into fund one, likely to come into your first close. Again, they're on the 100,000 to $1 million level, and they're relatively easy to close. Tech execs. Now, I've seen a lot of funds get closed to the tune of tens of millions of dollars with just tech execs as the LP archetype. And, some of these are going to be your first degree or second degree connections. So a lot of people start funds that have worked in tech, they've worked at Google, they've worked at Microsoft. And then it's like, okay, I'm talking with my former colleagues about something I'm doing. And they tend to be a little bit smaller in the dollar amounts that come in. You don't see them coming in at the $1 million level, but you see them coming to as high as $500,000 level. They'll come in, as I said, to fund one and fund two. They'll join the first close, and they're relatively, again, easy to do. And I've literally seen a number of funds raise the whole amount to the tune of tens of millions of dollars from tech execs. Okay. So this is a great LP archetype. Exited founders we used in the example in the beginning. Again, hopefully you'll have some first and second degree connections to exited founders. They'll come in to fund one, fund two, and beyond. They'll join the first close. They tend to be, again, up to about $1 million, and they're relatively easy to bring in because a lot of exited founders are like, I want to deploy capital into cool things. Oh, wow, you're a manager. You're going to be doing deployment into cool things. I'd love to chat with you about it. I'd love to see the companies you're looking at. So they're going to be pretty hands-on, pretty enthusiastic. They could add value. They could even be venture partners. So exited founders are a very, very valuable LP archetype. Angels is another obvious one. These guys can be tricky. I think many people here are angels. And so a lot of angels are like, what do I need you for? And let me just talk to you about that for a second. So as an angel, unless you're doing something like 12 deals per year, um, it's really difficult to get the diversification that you need to get great returns. So angels in general, if they're doing anything under 12 deals per year, should take some of the money that they're allocating to individual deals and put it into a fund for the purposes of diversification. Now, some angels have realized this and are doing this, but most angels have not. So it's an opportunity for you to educate angels that, hey, fund investing can be a very big positive for you. You might even provide angels with co-investment or follow-on investment opportunities based on your pro rata. So they can be a very good source of capital. Again, there'll be first and second degree connections come into fund one and fund two, usually not beyond. They'll join the first close. They're a little bit smaller. Maybe you see up to $500,000 commitments from angels. And now that they're a little bit more difficult because they're like, well, I can just make these investments myself. Why do I need you? Right? High net worth individuals, these could be, just people that have inherited money. I was talking with a high net worth individual earlier today. He had a very long career as a successful executive and now is kind of more consulting and a dilettante. And so they just have a lot of money for one reason or another. They may or may not be working. And they're a great source of capital. In fact, I would argue that a lot of emerging manager money, it comes from this LP archetype, especially on fund two and fund three, because these individuals have a lot of money, but they're a little bit more conservative. So you'll see it's, again, a lot of stuff, and they'll come into like all the way to fund 4, 5, 6, 7. But because they tend to be a little bit more conservative, in my experience, it's a little bit difficult to get them in on the first close or on the first fund. They tend not to invest huge sums, so you can see them go over $1 million. So maybe I should have written $1 million plus here, but especially for emerging managers, they tend to tap out around $1 million. And because they're conservative, they're not as easy as some of the other ones that you see here. But there's a lot of interesting stuff that happens with this group. So I'll give you an example. they tend to move in packs. So I've heard tons of examples of high net worth individuals, and I've had this happen myself, where one high net individual is like, I'm coming in, in this case was a billionaire. He's like, I'm coming in for $1 million. And he called seven of his other friends. And because he came in for $1 million, they all came in for $1 million, and I raised $7 million like that. I've heard of sports athletes in Europe. Similar thing. A friend of mine got 17 athletes in their fund because some wealth manager for athletes was like, this is interesting. One or two of the athletes said, I'm coming in, and they're high net worth individuals. And then a bunch of the other athletes also joined as well. So there's some dynamics like herd mentality, so to speak, that you can use with high net worth individuals that's very effective. Um, Small business owners, now you're starting to get a little more difficult. I actually closed a small business owner yesterday. So they're a great source of capital. They came in for about $500,000. So you don't see them come in over 500,000 very often. It does happen, but they tend to be about 100,000 to 500,000. And they can be first and second degree connections. They tend to come in on fund one and fund two, usually by fund three, because they're a little bit more difficult to close. The managers don't really want to work with them as much. They're a bit more conservative. They have cash flow issues. So there's a lot of you know challenging issues with small business owners, but they do make for great LPs. A lot of them are in areas related to your fund, which makes them a good strategic fit. So if, again, you're doing an e-commerce fund, there are tons of small business e-commerce owners, and they would be a great target for you to have as limited partners because they get what you're trying to do, right? But again, they're a little bit more difficult to close, have cash flow issues, et cetera. Bankers, again, a little bit more difficult to close, like small business owners. They similar dynamic, except if you saw that the small business owners tended to cap out around $500,000, bankers can go up to $2 million. You know, bankers are very sophisticated on the whole when it comes to financial products, as you would expect, right? So you're going to need strong materials and a strong pitch and a strong ability to speak to your numbers in order to win bankers. But if you can get some bankers on your cap table or on your fund roster, that would be a great thing. As I shouldn't have said, it's kind of a cap table because if you're a limited partner, you go on a schedule. But if you can get some bankers on your Schedule A and your LPA, that's a great thing because they tend to invest a bit more money. They're very well networked. So if you can get one or two bankers similar to the high net worth individuals, you can get some other bankers, right? And they can come in for large amounts of money and really help your fundraising. However, as I said, they're going to be pretty strict on the financial diligence. Now we're going to move into some even more difficult targets or LP archetypes like family offices. So family offices are more organized on the whole. They're going to have either a manager or you might deal with one of the family members or principals. Um, they tend to be fairly conservative, so they're going to do a bit more diligence. They're not going to come into the first close. They will usually come into multiple funds way later, and you can see it's a much larger amount of money. You can get, I mean, above $10 million, but this deck is really focused on emerging managers. So I think they tap out for emerging managers around 10 million. And if you're ready, if you're institutional grade, which means you have a really strong data room, your materials are in great order, everything is going really well, family offices can be a great target for you, but they can put you through a much more intense process. And maybe I'll take a moment and talk about this here. So there are two types of closes when you're dealing with an LP. All the way to this moment, the manager, aka you, are running the process and you are organizing the materials and basically you're driving. Okay. When you start dealing with family offices and some of the archetypes we're going to talk about next, they're driving the process. So you're the in the backseat. You're the passenger, they're the driver. In all the LPs that I've said so far, you can be the driver. And that's a very big difference. When you're the driver, you say what happens next, right? You determine how the process goes. When they're the driver, they're going to tell you what's next. They'll say, next I need you to get me X, Y, and Z. Then I'll bring it to the family. Then we'll go back and do some more. So you're really at the whim of what their process is. And their process can take oftentimes months. And you're going to need to have your data room and all this stuff in really good shape. So you're going to need to be institutional grade. Corporations, so if you notice, family office goes to like medium to hard or medium to high level of difficulty. Corporations tend to be just hard, right? So you can know people at corporations, but most often you don't know people in the group that's making the investment decisions. And usually that's quite complicated. So they might have a biz dev or an M&A group or even a corporate venture group that sort of manages their LP positions, right? And then they have to go and maybe find an internal champion. And then they have to go to some sort of committee, and it might then need to go to the board. So generally, we don't see them come into fund one. They generally don't come into the first close. They'll come into the second close. So there are always exceptions to the rule. Again, they can be larger. So maybe they start at 500,000 and they go up to 10 million. But because of all the processes, approvals, the fact that you need to be institutional grade, that can be quite hard. And things can happen where like you're 100% sure it's a yes, you have everything ready to go, and they decide because their quarter was bad or whatever else, I'm not going to invest. And they leave in the last minute, right? So that's not great. Then you have venture funds. These are venture funds do invest in other managers for deal flow. But most venture funds, 9 out of 10 or more, are prohibited by charter from investing in other funds. So some funds do invest, but 9 out of 10 funds don't. So it just ends up being a bit hard. You really have to know, okay, this fund is definitely going to invest in other funds. You have to know the partners there. You have to have a relationship. And then there's a chance you can close venture funds. So I don't think this is a particularly good archetype, but I have seen managers raise off of venture funds and get many millions of dollars from them. So I put it on the list. And last in the sort of accessible category are fund of funds. They tend to be pretty hard. We have a fund of funds. They're going to put you through an institutional due diligence process. And pretty much all the last ones that I mentioned, starting at family offices, are going to put you through a diligence process that's more quote unquote institutional, which means that you need to have a institutional grade fund. And that means a very strong data room, strong references, strong background, any sort of track record, deal memos, ready to go. And fund of funds are probably going to be the most organized of anyone that we've covered in this presentation about all this stuff. And if you don't have it, you're not going to be able to close. Now, our particular fund of funds, which is called Decile Capital, we primarily fund new managers. So we understand that our managers are not going to have everything that a traditional institutional diligence process will need. So we help our managers prepare the materials to pitch us and eventually to pitch other funds and fund of funds as well. I'm going to throw some challenging archetypes out here. I mean, these are not really good archetypes in 2024 for most new managers, and they're a little bit better for emerging managers, but they're not even great for emerging managers, but certainly they're terrible for new managers. Sovereign wealth funds and government funds, they're just not, they really need to put a lot of money to work, and they put you through a tremendous amount of process, and they're going to waste a lot of your time. I'm going to talk about that in a moment. The same is true for endowments, insurance companies, and pension funds. So unless you're really on fund two after a very successful fund one, or fund three after a successful fund two, these archetypes are not where you should spend really any time. And I'm going to talk about LP Love in a moment. Okay. So I want to go through the process quickly of how to work with LP archetypes, give you some final advice about LP Love, and then I'll take your questions, and we're doing okay on time. Okay, so generally speaking, you want to target 3 archetypes that align with your fund thesis. And here's a tool that we have, and I can paste it right here into the chat, but I'll show it to you right now. So we have a tool that should allow you to very quickly take your thesis. So I put my thesis right here and put it into the tool. This is a GPT on ChatGPT by OpenAI. And, it's asking me for my thesis, so I just have to copy that again, paste it in. And what it's going to do is it's going to help develop these archetypes for you. So high net worth individuals, right? And all the things you saw in the beginning, this GPT is doing for you. But what it does even more is it gives you search terms and makes those search terms clickable into LinkedIn. And so you're going to get your different archetypes. Another one, exited founders, which we had a sample of in the beginning, give you the search terms. And then third is family offices. So there's a tool that you can use right now to brainstorm the type of archetypes. And you could, if you don't like these, right? Would you like more archetypes? Yeah, I'd like more. And it will just keep going, right? And you can help it clarify, etc. So the first step in the process, and we're making this a lot easier for you, is to identify 3 archetypes that you think are a good fit for your thesis. So obviously you need to have a thesis first. So the first step in working with LP archetypes is to pick 3. And we recommend that you only work with 3 at a time. And they'll talk about cycling through. And then it gives you links to click to search them, right? For some reason, it's missing Stanford Alumni Network, but right. So you're going to, and what you want to do when you click those links, by the way, is you want to go to people, probably see, it shows you first degree, second degree, third degree. If you're a new manager on fund 1 and you haven't done a close, you're only going to want to focus on your first degree people, right? If you're a new or emerging manager and you're on a second or third closing of your fund, then you can start going to second and third connections. But pretty much you're going to want to start with your first degree connections if you're just beginning. All right. So We made it easy, easy, easy for you to find these archetypes, right? Just spits it out. You can copy and paste it. We give you links to search for them, and you start building your lists. The next thing you want to do is you want to come up with a closing model, right? Which is like, and I'll show you an example, which is basically you want to start thinking, let's say you have a $10 million fund. How many LPs do you need to get to $10 million, right? So you say, okay, I'm going to need 20 $100,000 LPs for 2 million, 12, 250, et cetera. So, and then you could say, who are the LP archetypes that might go into each bucket? Like, where might I get $1 million from from 2 LPs? Where might I get $500,000 from 6 LPs, right? So once you have these archetypes that you think are interesting, then you need to put them into some sort of model, some sort of LP construction example like this. And this will give you then a sense of how you're going to get to your target fund size. And by the way, you don't start at the top. You don't start with the family offices and fund of funds at $1 million. They tend to come last because you kind of have to get your pitching and everything in order. So you usually start from the bottom up. So you say, okay, I'm going to start with 2,100K investors in my first close, right? Then I'm going to go for 12, 250K investors in my second close. Then I'm going to go for 6, 500K investors in my third close. And hopefully you can get some $1 million investors in that third and possibly a fourth close. So even though it's listed here by the biggest at the top, you start with the bottom and you work your way up. Okay. Once you have this model and framework, you're going to want to do more research than just the links on LinkedIn to find as many LP archetypes as possible, actual human beings that you know, again, preferably first degree, and if not possible, then second and third degree. So you use LinkedIn, you use Crunchbase, you use Google. You got to actually, I recommend that you take your entire contact list and you go through people as much as you can one by one, and you look at their job titles, backgrounds, and just see, hey, could this person be an LP? And if you have a pre-existing relationship with someone and you have a reasonable assumption that they are wealthy, then it is legal for you to pitch them. And I'll talk about general solicitation in a minute, but it's not okay for you to pitch people that you do not know and that you don't necessarily believe are wealthy. You need to know them and assume they're wealthy before you can pitch them. And that's the law. Okay. It's not just a Deo saying it to scare you or whatever. Now, there are going to be some LPs that you know, but you may not know well, or you know a little bit and you want to connector to them. And even if you know them well, it's always good to have a connector. So similarly, we have connectors are people that you know that know LPs. Okay. And we've built a connector search tool as well. So again, going back over here, I could say, I need connectors for my fund, right? Hopefully it will ask me, what is your 1 sentence thesis, right? So I don't need to have it spit stuff out. So I'm going to spit out my 1 sentence thesis, and then it will start brainstorming for you who might be good connectors to work with from your network. So it will say, oh, do you know any ecosystem leaders? Okay. Oh, that would be great connectors. Maybe in the ecosystem leader world, community influencers, right? And it gives you links to search for them again in LinkedIn, right? So e-commerce community influencer, right? And again, you'll go to your first degree connections and you'll say, oh, digital and e-commerce leader. Adam Sandler, ironically. And then, you can actually uh, reach out to them because I'm already connected to them and do various things. So you want these connectors because they're going to introduce you to limited partners that are relevant in your archetypes. And again, let's say you even know a limited partner. If you're talking to the limited partner about your fund and someone else also recommends your fund, that's the best possible scenario. You want a limited partner that you're talking to have multiple touch points saying that your fund is something smart to do. And then as that's happening, you're setting up meetings with these limited partners in the different archetypes. And as I was saying, you got to be careful about general solicitation, which is legal pretty much everywhere in the world, the US, Europe, etc. So you must know the person and you must assume that they're wealthy in order to pitch them. So if you don't really know a limited partner, you need to set up an introduction meeting first. It could be a 15-minute Zoom meet and greet, and you just get to know them. And once you've had that opportunity to get to know them, then you can go and pitch them, but you really need to know them first. So there are other little hacks. You can try and meet them at an event. Certainly, meeting them in person is a great way to get to know them, but it's very important that you just don't go randomly pitch people that you haven't met before and you're not sure if they're wealthy because that is illegal. You are violating general solicitation laws. Um, and then probably the most important thing that people forget is you've got to ask for money. Okay. And if I've seen people do 4, 5, and 6 meetings with LPs, generally speaking, it shouldn't take you more than 3 meetings to get to either a verbal commitment or a signed commitment, right? If you're dealing with if you're going through like a corporation's process, they may say, look, we're going to meet and then we'll do this and that. So it could be different when you're going through someone else's process. But if you're running your own process and you're at 3 meetings and you don't have a commitment, you are wasting time. And I'll talk about that in a moment. So there are lots of different processes that you can follow if you on your own side. You could have a lead, you could determine if they're interested, do a call, you could send them materials, do a meeting, a pack, So these are like some different kinds of processes ranging from slightly faster processes on the outsides to shorter processes in the middle. And to some extent, you have to figure out the process that works best for you, right? But at the end of the day, you always want to have about 3 LP archetypes that you're focused on at any one time. Okay. And what's going to happen is that if you're running out of people that you know in an archetype, or if you've pitched like 10 people in an archetype and you've really got no commitments, then you've got to move on to another archetype. And this is a mistake that I see a lot of people make in that they get stuck, right? And the reality is that with like, oh, I can't find anyone else. You just do a new archetype, right? When your pitch is no longer landing or maybe didn't land in the first place, if you're not getting commitments, move on. Find a new archetype. And, just so everyone here knows, the closing takes months and requires hundreds of LPs. Now, to pitching hundreds of LPs. I saw someone was asking about a link to the connector one, so I'll paste that in the chat for everyone. But closing is not something that's going to happen overnight. You should assume 200 pitches if you're in a developed market and you're organized and do things right. We train you on how to do things at VC Lab, and you should be able to close your fund with 200 or less pitches. But if you don't go through a program like VC Lab or you're in a developing market, it could take you 600 pitches to close, right? And the 600 pitches, that means finding the LPs, setting the meetings up, doing the pitch, and following up. And all that can take a lot of time. So, if you can find shortcuts to go from 600 to 200, it will literally save you years of effort, right? And VC Lab is one of those hacks. So I want to talk about LP Love briefly and leave you with some remarks and go to questions. So LP Love is a phenomenon that limited partners rarely say no because they want to maintain optionality and they string you along, right? So you're amazing, but your fund is too small. That's a no. We're over allocated, so come back next year. That's a no. We love the vision, but you need a little bit more experience. So they'll say things that are not like, is that a maybe? And listen, I'm a victim of this as well. I hear this all the time. And it's like, well, you didn't say no, but and these maybe aren't even some of the best examples. I've had people like literally say to me, we really love what you're doing. I want to stay involved. I'd love to figure out how we could be more involved. But your fund is a little bit, or you're raising a little bit too much. And it's like, what is that? So I don't know what that means. Like, okay, I know that's a no, right? But it's kind of like not really a no. So what I would say to everybody here is you're going to get strung along by LPs. They're going to say all sorts of things that don't sound like a no. And so first and foremost, if they say things like this, you're amazing, but your fund is too small, or hey, you don't have enough AI in your fund, do not change your fund strategy because an LP is saying no. They're just telling you something that sounds like a maybe because they want to maintain optionality. This does not mean you need to change your thesis. This does not mean you need to make your fund size larger. Do not change your fund because an LP said no. And basically, I'm going to make it super simple for you. Anything that is not a yes is a no. So if they're like, we love what you're doing and we think AI is the future and you don't really have enough AI in your fund, that's a no. Okay. It's not, oh man, if I add AI and come back, they're going to invest. No, that's just a no. So anything that's not a yes, and then when I mean a yes, I mean an explicit yes, is a no. All right. And right now is one of the best times in history to start a VC. I mean, it's certainly one of the best times to be an investor. We're seeing the largest number of closes in July ever. And so, yeah, go in, find the gold. Hopefully, it's not fool's gold or, or fake gold. And those little veins of gold are going to be mined by using LP archetypes. And we're here to help at VC Lab. And if there's anything we can do to help accelerate you closing, we will do it. All right. So here's what we're going to do. I'm going to take some questions now. We have 8 questions in the Q&A. Can I please have a PDF of the slides? We'll be sending out a video afterwards, FY, Eliza. I would love to know the best way to build and scale your LP and VC networks. So yeah, I mean, at the end of the day, your first and second degree connections are going to be very important here. And so if you don't have a lot of first and second degree connections, you're going to be in trouble. And so, how do you get first and second degree connections? Well, number one, you post a lot on social media and you go out a lot, right? That's it. So if you're a hermit and you're not doing a lot of stuff where you're going out, you're speaking at events, you're posting on social, you have to change that. And that's how you grow your network, right? Going out, speaking at events, attending things, whatever they may be related to your industry. And then secondly, posting novel insights, resharing, liking, and being very active on social. You need to do both of those things. Zing is asking, uh, great mind-blowing VCL GPT plugin. What's the common bottleneck to close for easy types of archetypes? You just a lot of people don't pitch the archetypes. Okay, a lot of people end up uh, getting paralysis by analysis. They're overthinking things, so they don't actually go. They're like, oh, I need to have this, I need to do that. So they actually don't go and pitch. So, my whole view on this is you got to get out of the building and start pitching as soon as possible. And a lot of people fight with us about this. They're like, no, you don't understand. I'm not ready. I mean, you're never going to be ready if you can't pitch your friends, then you have an issue. You should be able to pitch your friends with the most half-baked thing possible to get feedback and then go from there. All right, so lots of questions coming in, which is great. Uh, when you say know them, to what extent do you need to know them? So you just have to have a pre-existing relationship, right? You can, if you haven't done so, that we have an AI called Decile Base. You should ask Decile Base about general solicitation and all these questions, Deborah, and it will help you. But you have to have a pre-existing relationship. So you must have met them or interacted with them before you can pitch them. Let me refresh the most popular. There's a thumbs up button in the questions. Do me a favor right now. We got a lot of questions, so I can move through them quickly. But before you ask a question, thumbs up another question so that we can get to the more popular ones. Is it okay if the LPs are not in the geography that I'm focused on, but they might have an interest in new markets? This is Mehmet. So that does happen where some LPs will be, let's say, in Europe and back a fund in Africa. That does happen, but that's pretty rare, right? So every time, and this is an issue for all funds, if you're a fund, you're a pass-through vehicle. So when you make an investment, it's almost like the LP makes an investment because it's pass through. So the LP will have tax consequences, regulatory issues, etc. So if you're investing in 10 countries, all of your LPs will invest in those 10 countries. All of your LPs will need to comply with the tax and regulatory issues of each of the countries where you invest. And so a lot of LPs just don't want to deal with that, right? So they'd rather invest in areas that they know. So it's like European investors like to invest in, or European LPs like to invest in European funds, and American LPs like to invest in American funds. Very rarely do you see American investors investing in European funds because they're like, oh, I got to deal with all this tax and regulatory headache that I don't really understand, and vice versa. So that's unfortunately how it goes. Can you please? Okay, we did that. Um, if we could clear some of the redundant questions, that would be super helpful, Dominica. All right. How do you describe what you're doing at networking events to get potential investors interested without general solicitation? You don't. Okay. You cannot describe your fund. You cannot describe pretty much anything related to your investment activities. You can say that's why it's much easier for people who are specialists to start funds, because if I'm an AI expert, I can go to AI conferences and talk about AI as an AI expert all day long, and I don't need to talk about my fund. I can meet LPs and say, hey, I'd love to talk to you about some things that I'm working on. And then you follow up with them after you meet them. So you cannot talk publicly about your firm or your fund if you are fundraising, because that is general solicitation. Now, if you're on fund two, obviously you can talk about fund one because fund one is closed. And by the way, this isn't like you do a first close and now you can talk about it. You have to close the entire thing 100% and cease fundraising before you can talk about your firm and your fund. Um, okay, so let's see. Remember to upvote here because we have lots of questions. John was saying, fun one, we could tell in a meeting if the high net worth it was in about 80% of the time. Can we expect to get clear indications of interest for fund two in the first meeting? I think everyone here should be able to get a sense whether a LP is interested in the first meeting, because generally speaking, the meetings you're going to have buy signals and you're going to have sort of negative signaling. So if they're asking a lot of questions that are like skeptical, like, I'm not really sure, I've heard a lot of negative things about venture, what do you think? Or your thesis seems like there's a lot of competitors and it's really a crowded market. How are you differentiating? So if they're asking questions with like a negative lean, it's pretty much a bad sign. But conversely, if they're really engaged, they're like, I can't wait to learn more. I love, and they're proposing next steps and they seem really exciting. So you should be able to tell in the meeting if someone's leaning towards a yes or leaning towards a no. And the reality is, like, you gotta just, you're a shark, right? You're swimming through the water, and sometimes you're going to get something, but a lot of times you're going to miss. And your job is like, okay, it's a miss, move on, right? It's a miss, move on. You can't get hung up in the no's. If the meeting goes well, you got to find the people that are a yes, right? Adam's asking, we haven't gotten to deck building in the cohort. Are there other materials we should be using to close LPs in the meantime? Um, no, no, you do not need a deck to close. You do not need materials to close. All right. Materials are a nice to have. Um, they are not needed. In fact, all the best closers, myself included, um, don't, materials, if you have them, you can use them, but they're definitely not needed. You can get to a yes in a meeting with nothing, right? And in fact, a lot of the best closers also don't use materials in the meeting. So not only do they not use materials in the whole closing process, they don't use them in obviously in the meetings either. So materials are a bit of a crutch, and you should be able to close without materials first. And then, as you move, remember you're starting at the bottom and moving your way up. So as you're moving your way up to larger and larger LPs, you're going to eventually need materials because larger LPs will request materials, including request a data room. And only then do you need it. But in the beginning, when you're pitching friends, when you're pitching angels, when you're pitching a certain high net worth individuals, you just do not need materials. And they're a crutch. And so you should get good at pitching without them. What advice do you have for someone looking to transition into a venture scout or fundraising role to establish GP? Join the Venture Institute, and maybe we could go to govclab.com, and there'll be a Venture Institute. We do training on how to do that, and walk you through everything. Okay, couple more questions. Samelia is asking, we discussed tech execs and bankers as LP archetypes, but who exactly would be great LPs here? Um, how high up the corporate ladder? Da, 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 da. So look, um, most people working at Google, Meta, and bankers, et cetera, I mean, they're getting paid tons of money, right? And so some of those people just buy vacation homes and things like that and live kind of lavish lifestyles. But a lot of people kind of save money in those roles and don't have a ton of like lavish lifestyles. And so they actually are sitting on a lot of cash. And so they can make investments kind of at any level, because they're paid well. Like Google pays people very well, Meta pays people very well, banks pay people very well. So they may have conflicts and things. So I wouldn't think how high up the ladder. It's actually pretty low on the ladder. But you tend to see lower people on the ladder don't have as much money as people higher on the ladder. So that's just the nature of the beast. Okay. Can a venture studio talk about startups they are working on without mentioning they are raising a fund? Yeah, obviously. So if you're working on a startup, you can talk about the startup. But actually, the general solicitation rules apply to startups as well. And so startups are not allowed to do general solicitation either. They can't be like, I'm fundraising. That's illegal. There's an exemption for demo days. So that's why demo days can happen. But generally speaking, the uh, general solicitation rules apply to everyone, startups, funds, etc. People don't enforce them as much with startups, but they definitely get enforced with funds. Last question here. What are your views on pitching high net worths who are not from the tech space or have not been LPs? So I'll answer that question in saying, like, generally speaking, if you're pitching people that have not been an LP, that can be a pretty bad idea. So I would avoid that. If they're really interested in being an LP and you're okay in spending a little bit of extra time, then you can pitch them. But generally speaking, you want to pitch people who know a little bit about what they're doing. Otherwise, they're really going to waste a lot of your time. All right, everyone. Thank you very much. Maybe we could see in the chat, was this useful? Was it helpful for everyone? I certainly enjoyed it, and I just want to say thank you for participating. This was great for me as well.